Hello everyone. I hope you are taking good care of your health and staying safe in COVID-19 crisis. Our economy and our market is caught among a perfect storm. Medical crisis has resulted into shutdown of economic activity. Shutdown of economic activity is resulting into crisis in financial market. We have seen sectors like hotel, tourism, travel, aviation, multiplexes, newspaper and advertising, retailing, all getting hit very badly. Their revenues have plummeted and their costs have continued. Leverage companies are also finding it very difficult to pay their debt. We have seen IIT numbers collapsing in March itself. Obviously, April numbers will be even worse. We have seen steel production down about 87%, power consumption down about 23% in April. The PMI numbers are also one of the lowest in whole of Asia for the month of April. Clearly, this is reflected into fourth quarter GDP growth, which came at 3.1%. It's almost 11 years low in terms of quarterly GDP growth. Many agencies are forecasting that in FY 2021, India will go into negative growth trajectory. Our GDP will contract by about 5%. This shows the impact of perfect storm on Indian economy. Our economy is in no different zone than the global economy. Despite all the challenges, markets have risen, and as I speak, markets are trading at about 9,850 Nifty. What is Nifty discounting at 9,850? Why is it not falling? Because economy is going to contract? Well, markets are driven by flows and fundamentals. Let's talk about the flows. We have seen record capital raise by companies like Reliance Industries Limited. We have seen record absorption for stock of companies like Hindustan Unilever and Kotak Mahindra Bank. It shows that for good Indian companies, there is no dearth of capital. Foreigners as well as domestic investors are happy to participate. If you remember, in our monthly presentation since March, we have talked about MSCI rebalancing and FTSE rebalancing. Both these agencies are going to increase India's weight in emerging market indices, and that will bring billions of dollars into Indian equity market over a period of time. These flows are supporting markets in the short term. However, market is also discounting future. At 9,850 Nifty, market is discounting lower oil prices. Market is also discounting that massive economic package announced by the government and RBI will work on the ground. RBI has pumped more than 8 lakh crore into banking system. Market is discounting that this monies will leave the coffers of the bank and move into borrowers' account. RBI has cut interest rates on repo rate by 110 basis point and on reverse repo rate by 140 basis point. Market is discounting that this rate cut will be felt by the borrowers also in terms of lower borrowing cost. The government has announced massive schemes for MSMEs, for NBFCs, for bottom of the pyramid population. Market is discounting that all these schemes will start working on the ground, resulting into economic recovery. Most importantly, market is also discounting that a medical solution is going to come sooner rather than later. A combination of drug or a vaccine will leave coronavirus behind and economic activity will return to normalcy That is what is discounted by the market at 9,850 Nifty. There is one more thing which market is probably discounting. I'm sure all of you have seen Sonam Wangchuk's video about boycotting Chinese product. India runs a trade deficit of $60 billion with China on an average for last year. Market is discounting that now Indians will boycott Chinese products and will help bring down this trade deficit. This combination is allowing market to rise despite economic indicators going into reverse direction. Now the next question which comes, will market rise from here? Will market continue to rise from here? Well, it's always difficult to predict in the short term what will happen to market. Our belief is that market will fluctuate. On the days when there are good news about number of impacted persons, number of deaths, medical solution, fiscal stimulus, monetary stimulus, global development, markets will go up. On the days when there is absence of those news, markets can come down. In some sense, market is discounting a potential future scenario in terms of return to normal economic activity. If the actual situation over next couple of months is better than what is discounted by the market, markets will go up. If it is worse, then markets will come down. And hence we are saying that markets will fluctuate. The next question then comes, should we be overweight equity at this point of time? Well, if you see our call in March, April and mid-May, we were recommending overweight equity as market cap to GDP ratio of India was hovering at 55 to 60%. The historical average market cap to GDP ratio is about 76%. And this discount, this below historical average valuation of market cap to GDP ratio encouraged us to give overweight call on equity. Now that discount has narrowed down a bit, and hence to that extent we can become from hugely overweight equity to marginally overweight equity. If that gap narrows, we can become neutral weight equity. If that gap widens, we can again become overweight equity. Essentially, that discount will determine how much should be your overweight in equity. Next question then comes, should we buy large cap, mid cap, small cap? Well, if you see the correction from large cap, mid cap and small cap, it's maximum in small and mid cap. Small and mid cap had fallen to 6 years and 9 years before level, whereas large cap had fallen to 4 years before level. Market today is like a time travel machine which allows you to go back in the past and buy Nifty index or Nifty mid cap index or Nifty small cap index at 4 years before, 6 years before and 9 years before level. Depending upon your risk profile, we will recommend you to be overweight large cap or mid cap or small cap. For conservative investors, large cap will be preferred. For average investors, multi-cap will be preferred. And for aggressive investors, small and mid-cap will be preferred. Do remember that generally post-correction, it's the large cap stocks which starts moving first. The next question then comes, how should we make investment? Well, we have always recommended systematic transfer plan rather than lump sum investment. Bearing balance advantage fund and asset allocator fund, we have always recommended investment in tranches rather than in lump sum. In the current environment also, our philosophy remains the same. Please divide your incremental investments in two parts. One part to be invested when medical solution has not emerged, when normal economic activity has not yet resumed to full extent. You could be investing that money in multiple tranches whenever market is correcting, whenever market cap to GDP ratio is widening vis-a-vis historical average. The other half can be kept to be invested when medical solution emerges and normal economic activity resumes on a permanent basis. That way, we will be able to average into this market. The next question then comes, should we continue our SIPs? Well, when you have financial emergency, then certainly it's worth pausing SIP or even cancelling SIP. But just because SIP gave negative return, that's no reason to stop SIPs right now. In all our monthly presentations since March, April, and including in May, we will be circulating charts of how SIP returns in our funds have deviated when markets are good and when markets are bad. You will see wide divergence between SIP returns in Jan 2020 versus April 2020 and May 2020. These are the levels to buy. If at SIPs, you will not be buying when markets are cheap, and hence when market goes up, your SIP returns will not move as much as it should move otherwise. So please continue your SIP unless until you have financial emergency. The next question then comes, apart from equity fund, should we be looking at some other products? Answer is yes. Many distributors, many investors have not considered hybrid funds in their portfolio. You have two conservative hybrid funds like monthly income plan and equity saving schemes where equity exposures are on the lower side, but at this point of time could provide better return than pure debt product if medical solution emerges and market starts moving up. So apart from normal equity fund, do look at hybrid equity fund with low equity allocations like monthly income plan and equity saving schemes for your customers' portfolio. Undoubtedly, we are going through a challenging period. We are passing through a perfect storm. But obviously, that's the reason why markets are trading below their historical averages. We believe this is great opportunity to buy stocks and build portfolio. It's time to be diversified rather than sector concentrated. It's time to be calibrated rather than lump sum. It's time to be invested rather than trying to wait outside the market and time the market. Markets undoubtedly will fluctuate, but a long-term investor can still make money out of this markets. I would like to conclude by sharing two experiences of 2008 and 9/11. When 9/11 happened, New York Stock Exchange was shut for a few days. In those days, many people thought now airlines will never fly again, or if they fly, there will be 2 soldiers per passenger. That fear resulted into so much negativity about the sector that after a few days gap, when New York Stock Exchange opened, airline stocks plummeted to the bottom. Over next 1 month, airline stock became best performing sector as the fears discounted by the market were proven wrong. Planes did start flying and there were marshals on the plane, but not in the proportion as market had feared. When the actual situation in aviation sector was far better than what was priced by the market, aviation sector became best performing sector despite the problems faced by the aviation sector post 9/11. The limited point here is that market always discounts the scenario, and if actual scenario is better than what is discounted by the market, markets can rise. Today, market has discounted COVID-19 risk, and if the actual scenario works out to be better, then markets will rise from current level. The second experience is about 2008. In 2008, markets corrected from 21,000 to 8,000. There were people who gave buy call at 21,000 Sensex in Jan 2008, and the same people were giving a call in 2008 October at 8,000 Sensex for selling. These people were trying to time the market on momentum and they failed miserably. the other hand, people who stayed invested right from 21,000 to 8,000 and further onwards made money despite ensuring the entire volatility. People who invested in a falling knife when markets were correcting from 21,000 to 8,000 and kept on averaging, they also made money. Effectively, people who tried to time the market by and large lost opportunity. People who stayed invested by and large made money. Almost all the equity mutual fund schemes crossed their all-time high NAVs before Sensex had touched 21,000 level. At Kotak Mutual Fund, our endeavor will be to ensure that we cross all-time high NAVs for our equity schemes for our unit holders before market crosses its all-time high through appropriate portfolio positioning. Stay safe, stay healthy, and also stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.